The next section we're going to look at is how to account for fixed assets, including depreciation. The first thing we can look at is how do we account for the cost of fixed assets? So this would be that initial cost. And of course we have some items here that you're familiar with: land, buildings, machinery and equipment, furniture and fixtures. And we see that the initial cost may include different things depending on what the asset is. So starting at the top with land, of course it's going to include the purchase price. There may be some fees associated with the purchase. So all of that is going to come into play with that initial cost that we'll have to record. With buildings, there's going to be a purchase price, or if we constructed the building ourselves, there would be our own cost to build it, and then also any related fees. Machinery and equipment, we've got the purchase price, any shipping, if there were any installation costs and things like that, any fees, those would factor into the cost. And also furniture and fixtures, same way. We may have shipped the assets, we may have had them installed or assembled, and all of those types of costs and fees would factor into the initial cost. So this is just a sample journal entry of recording the initial cost of various kinds of fixed assets that we just talked about. All we have to do is debit that asset account by name, and then we can credit cash, or if we took out a mortgage to purchase the asset, then we might have credited mortgage payable or notes payable or something to that effect instead. But this assumes that we kind of purchased each of the items individually rather than purchasing them as a group, which we'll look at in a second. What we can look at now is what happens if we want to purchase multiple assets in what's called a lump sum purchase or a basket purchase. So we're going to pay one price and we're going to get different kinds of assets. Well, what we have to do is we have to allocate the purchase price to the assets based on relative market values. And you'll see in a moment what that means with an illustration. Step one is that we calculate a ratio of each asset's market value to the total market value for all assets combined. And then in step two, we calculate the cost allocated to each individual asset by multiplying the ratio from step one by the total purchase price. So what we have here is just an illustration of how we can perform step one with this basket purchase or this lump sum purchase. Step one is calculating the ratio of each asset's market value to the total market value of all assets combined. And so we can start at the top here with land. Now we see that the land in this basket purchase had a market value of $10,000. The total market value down here at the bottom for all three items was $60,000. So all we have to do is take $10,000, divide it by $60,000 to get to 17%. So of the total market value, the land represents 17% of that, and so on and so forth with the building and then the equipment. Secondly, we can look at step two, calculate the cost allocated to each asset by multiplying the ratio from step one by the total purchase price. So if we start here with land, remember from the previous slide we noticed that the land comprised 17% of the total market value. Well, all we have to do is take the total purchase price, $50,000. This is what we paid to acquire all three assets. We multiply these two together to get to the cost that we're going to allocate to land itself, which in this case is the $8,333. And so on and so forth. For the building, it turned out that the building was exactly half of the total market value. So we allocated, of course, $25,000 to the building. Okay, we're going to move on to accounting for depreciation of fixed assets. So what is depreciation? As we see here at the top, depreciation refers to the physical using up of assets and the accounting process of allocating the asset's cost to expense over the asset's useful life. So this is important. When we use the word depreciation, we could be referring to what happens physically. So a truck that is wearing out over time. That we would use depreciation to refer to, but we would also use the term depreciation to refer to what we're doing in the accounting records. In the accounting records, we're trying to allocate that initial cost to expense on the income statement over the years of that asset's life. So depreciation means both of those things. And with depreciation, we're always going to have a useful life, as you see here, and that's just the expected life of the asset. And that could be in years, or it could be in units of output, such as miles, for example, on a vehicle. So what are we going to get out of the asset is what that's asking. And then we could potentially have a residual value that comes into play in calculating depreciation. And all that is the expected cash value of an asset at the end of its useful life. So this box at the bottom we have, it's just an image of how these items come together mathematically to get to our yearly depreciation. In this case, we're looking at the straight line method. So we start at the top with the initial cost. We can see it's 110. Now, for this item, at the end of its useful life, we're anticipating that we'll collect $10. Maybe we'll sell it for scrap for $10. Well, since it's going to have that value at the end, that value itself, the 10, is not going to be depreciated ever. So if we take the 110, we subtract the 10 residual value, we get a $100 depreciable cost. So this is the amount that we actually will depreciate over time in the accounting records. So obviously, if we had a 5-year useful life for this asset and we were using the straight line method, it would simply be a matter of $20 of depreciation per year. So the first method that we'll look at to calculate and account for depreciation is the straight line method. And this is the simplest method of all. All we do is record an equal amount of depreciation expense every single year for the number of years of the asset's life. So if you look at the top box here, the equation is very simple. Start at the top left with cost. We deduct that residual value. And if you remember from the previous slide, the cost minus the residual value is known as our depreciable cost. We divide the depreciable cost by the useful life in years, and that gives us our straight line depreciation expense per year. And then at the bottom box here, we've just plugged in our numbers. We started with the 110. We subtracted the 10 of residual value. So we had $100 of depreciable costs. We divided that by 5 years, and we have $20 per year of depreciation expense under the straight line method. In this slide, all we're seeing is the journal entry that we would record if we wanted to record our first year of depreciation expense. All we have to do is debit depreciation expense and credit the accumulated depreciation account. What we have here is called a depreciation schedule. So if we start at the top left, we notice that we want to look at what year we're talking about. Year 0, that represents the moment that we purchased the asset. And so on and so forth, years 1 through 5, because this asset had a 5-year useful life. We start with the asset cost here, that original cost of 110. We calculated our annual depreciation as $20 per year, so that goes in this column. The accumulated depreciation is just that. How much depreciation expense have we recorded over time cumulatively? So we started at 20, and we add 20 for year 2 to the 20 from year 1, and we get, of course, 40. Now, this is a term we haven't seen yet. This is called book value. It's also known as carrying value. The moment when we purchased the asset, of course, it was 110. But after the first year of depreciation, it's going to, of course, go down to 90 and then 70 and so on. And if you notice, it goes down all the way to 10, which always has to equal the residual value. The next method we can look at is called the units of production depreciation method. And the definition is as the name implies. A fixed amount of depreciation is assigned to each unit of output produced by an asset. So it's not like the straight line method where we're assigning a depreciation amount to every single year. Instead, we're assigning an amount to every unit. So this could be miles of a truck, for example. So we start in the top box. The equation is very simple. We take the cost, we subtract the residual value, just like we did with the straight line method. Then we take this depreciable cost, we divide it by the useful life in units, not in years, and that gives us the depreciation expense per unit, not per year. So if we plug in the numbers, we started with 110, we subtracted the 10 of residual value, so we have $100 of depreciable cost. In this case, we're going to say that this asset will give us 100 miles in its life. So we divide the depreciable cost by 100 miles, and that gives us $1 per mile of depreciation expense. And all we have to do to calculate depreciation expense for any given period of time, such as a month, is we take this depreciation expense per unit and just multiply it by the number of miles driven in that month. So if 10 miles were driven in that month, it would be the 10 times the 1, so it would be $10 of depreciation expense. And we would record the journal entry just like with the straight line method, debit depreciation expense and credit accumulated depreciation. This next method, the double declining balance method, is a little bit different. As it shows here, this is an accelerated depreciation method that computes annual depreciation by multiplying the asset's decreasing book value by a constant percentage that is 2 times the straight line rate. Now that's a lot of words and it may not make sense just reading it. It's much easier to look at the equation here in the top box. So really all we're doing is we're starting out and we're saying if we take 1 and we divide it by the useful life, which is in years, we're going to get some kind of percentage. So with the asset we were looking at that had a 5-year life, if we took 1 and divided that by 5 years, that would of course be 1/5 or 20%. Now, way back when we looked at the straight line method, that was the depreciation expense per year. It was actually 20% of the $100 depreciable cost. Well, with the double declining balance method, the double is kind of indicating that we're going to double something here. And what we double is this percentage. So now we take this, what was 20% for us, multiply that by 2. Now we're at 40%. So it becomes 40%. We multiply that by whatever the book value was at the beginning of the year, and that gives us the depreciation expense per year. Now what we have here is simply a depreciation schedule for the double declining balance method. So it's got a few more columns than the schedule we saw for the straight line method, but it's really not that hard. What we do is we start out with an asset cost of 100 at year 0. So the moment we've purchased the asset, that's what year 0 is representing. Now, it's not 110, the initial cost. It's actually 110 minus the 10 of residual value. So that's one difference with the straight line method and also with the units of production method. With the double declining balance, we don't factor in that residual value here at the top. We just take the depreciable cost. So we start with the 100, and then here in year 1, we take what's called the double declining balance rate, and that was, as you saw on the previous slide, in the equation, that was the 1 divided by 5, but then multiplied by 2, or doubled, as the double declining balance name implies. So here we've doubled the straight line rate. We take that, which is 40%, we multiply it by the book value at the beginning of year 1. Well, the beginning of year 1, it was, of course, 100. So the 40% times the 100, that gives us $40 of depreciation expense for year 1. And that's also the cumulative to date for year 1 as well. So the 100 book value is now down to 60. At the end of year 1, we start year 2 with a book value of 60. So 60 is the beginning for year 2. But we take the same rate, the 40%. We always use that same rate for every year. So in year 2, we take 40%, multiply that by the 60. Now we only have $24 of depreciation expense for the year. And if we add the 24 to the 40 from year 1, now we have a total or cumulative of 64 for the 2 years combined. So the book value at the end of year 2 is all the way down to 36. And it goes like this for every year. The same process is applied. But if you'll notice here, at the end of year 4, we were down to 13 book value. If we had taken 13 and multiplied that by 40%, we would have had a depreciation expense that was so high, it would have depreciated the asset down below $10, and we can't do that because we still have the residual value of $10, which means it can never be depreciated below that point. So this is kind of our floor. This is the lowest we can go. So knowing that this is the lowest we can go, the depreciation expense for year 5 has to be $3 exactly. It can't be any more. And that gives us the 90 at the end of year 5 and the 10 of book value, and we're done.